Today I would like to talk about Nestle. It's one of the biggest food companies in the world, and this company is not liked by everybody because they had scandals in the past. So still, I would like to analyze this company today, and they sell a lot of different products. They sell baby products, they sell water, cereals, but also coffee and ice cream. So it's an interesting company, and we also can see here they trading down 4% in 5 years and 13% in 1 year. And if we look, the highest was in 2021 and it's down about 24%. So it's an interesting company, but we have to take a look at the financials to understand better about it. The first thing we can recognize is the market cap of 227 billion Swiss francs. So this is already the very big company, and it could mean it will be difficult to grow more in the future. So the market cap is shares outstanding multiply with the stock price. So the next thing we're going to do is look at the financial foundation. So we are looking for revenue growth over the last 5 years because we want to invest in a growing business and not a declining business. So if we take a look here, we can see in 2019 it was about 92 billion. And now in 2023, it's in 93 billion. So it did grow, but not very much. It's not a big number. And we also had the decline in COVID. So it's still a check here, but it's not a really big growth over the years. We would also like to see the free cash flow growth over the 5 years. This is a very important number because the free cash flow is used to pay the dividends or buy back the shares. So we want this to grow. And we can see here in 2019 this was about 12 billion. And now in 2023 it is about 10.2 billion. So it's actually a decline. So this is not looking great. It's not a check here. The next thing we are looking for is a free cash flow yield over 4%. This can also tell us something about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. But let's take a look first. So we already have the free cash flow here. It's 10.23 billion. So we're going to take this number and then we're going to divide it with the market cap of 227. So if we calculate this, we will get the free cash flow yield. Okay. This is the number, and it means we have over 4% dividend yield, 4.48%. So that would be a check here, but it's not too great. What it could mean this company is at a fair value. Now we want to take a look at the debt to free cash flow ratio. We want this to be under 5. This means we can pay back the debt in under 5 years with our free cash flow. So it's a very important number because if a company has too much debt, it could lead to bankruptcy. So we want to take this serious. And we can see here they have short-term debt of 9.4 billion, and we will also take the long-term debt that we can see here. It's over 45 billion. And then we're going to divide this number with the free cash flow. So the number that I have is 5.4. So this means in over 5 years we can pay back the debt with our free cash flow. So it's not a check because it's over 5. We would like to see it under 5, and this is not the great number. So it could mean they have a little bit debt too much, and it's taken longer to pay this back with their free cash flow. The last thing we are looking for is shares outstanding decrease. So if we have the company that looks undervalued, we would also like to see the company buy back shares, especially if it's already the accomplished company and is not really growing much. So we can see here they did actually buy back shares over the 5 years, and it's a good amount as well. So we can see the decrease of the shares outstanding. So it would be a check here. So this is actually a good thing, but obviously they need to be carefully as well. They should not have too much debt and finance this share buyback with debt. This is not a good thing. So they should finance this with the free cash flow. I would like to give my conclusion about this company. Let's start with the good things. So we have the free cash flow yield over 4%. It's at 4.48%. So this is not looking too bad. The other thing that is good is the stock buyback. So they buy back their own shares. So this can increase the stock price. So the negative thing would be difficult business. So I think this is a difficult business because there's a lot of competition, and it's very important for this company to have a good branding and get the popularity. So they also have a lot of supermarket brands nowadays, and they are way cheaper. So people maybe, when we have the recession, tending to more buy the cheaper products. Also, what I'm asking is too much debt, because the debt looking not really in a good level. It looks too much to me because they cannot pay it back in under 5 years with the free cash flow. The last thing would be bad image. So I think a lot of people dislike this company because they had the scandal in the past, and I think the image is very important. So that's why I don't really like to invest in this company. But they could look cheap in their financial way about the free cash flow. So they're also trading, when we look at the 5-year charts, they're also trading not very high. But it doesn't necessarily mean that this company is a good buy right now. I personally wouldn't invest in this company. So I hope you liked the video, and please don't forget to subscribe and like the video.